Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're really well, that you're having a really fantastic week. And for those of you who have 18-year-olds who are waiting for big exam results and university places today, I wish you all the best of luck. We have this going on in our house, so you imagine it's a fairly stressful environment this morning, shall we just say. Now, in terms of stressful, actually, the inflation numbers have also just been released. So we're going to cover off that for you today. We're also going to talk through our usual kind of what's happening with interest rates, what the lenders are up to, and also update you on lending criteria changes that we've seen in the last week. We're going to also be sharing with you some information that's been released on a report which shows you the kind of things that tenants are really looking for when they're renting properties. It's really interesting reading. And then lastly, we've also got for you a report which talks about the areas at which get the best yields in the UK at the moment. And then finally, actually, because I haven't done this before, I'm just going to give you a quick update on what's going on with the very epic journey that was the getting back of my buy-to-let for my non-paying tenant and then getting it re-let as well. So we're reaching a conclusion on that, so I'll bring you up to speed on where we are with that too. Okay, it's been a pretty data heavy number in terms of economic data that's been released in the last week. So the first thing that came out was news about GDP. GDP in the last month had increased by 0.5% or 0.2% in the quarter. Now that is obviously a really good thing. We don't as a country want to be going into recession. However, this had an adverse effect essentially on swap rates. So they started to climb. Added to that was the news about wage growth. So annual wage growth, 7.8%, the highest on record. So the capital markets have reacted to this and swap rates essentially started climbing again. So to give you the numbers, as of 10:30 last night, it's currently 7 o'clock on Wednesday morning. 10:30 last night, 2-year swap rates were at 5.573. 1 month ago, they were at 5.733, so no real change month on month. Although we had started to see things come down, they've gone back up again. Same news for 5 years, unfortunately. 5-year swaps, 4.907, 1 month ago was 4.938. So again, we're kind of back to where we were. It does feel a bit like 2 steps forward and almost 1.5 steps back at the moment. Now, the thing that's happened this morning is that the inflation data is being released. So it's good news, actually. Well, on the headline is good news. So inflation has come down to 6.8% from 7.9% last month. And this is largely driven by a reduction in the energy price cap and some food costs rising less rapidly. However, core inflation has remained at 6.9% and services inflation has actually gone back up to 7.4%, which is the highest level since 1992. Now, I haven't got the latest swap rate data that's come out, unfortunately, because of the timing of when we record this video and then we send it out to our database. I haven't got time to, or won't be able to get the latest swap rates, but I'm wondering, whereas we were hoping that actually we'd see a kind of step back down from on swap rates, I'm slightly concerned that we're not going to see that because of the underlying core inflation not actually moving, combined with all the other news that we've had. So let's watch this space. Of course, I'll report back next week, but you can actually watch the swap rates yourselves and find out what's going on. Now, on the back of the inflation news that's been announced, very much the expectation is the base rate will be increasing again in September. There will be another set of inflation data that comes out before that, so let's just wait and see. But at the moment, the thoughts are very much that we'll be seeing another 0.25% increase in September, I'm afraid. Okay, now we have had a good spell of lender pricing changes in the last week, largely favourably if you're a borrower. So first of all, we've seen the Coventry reduce some of their 5-year fixed rates on lower loan-to-value bandings of 65% loan-to-value and below. We've seen NatWest reduce some of their rates by up to 0.25%. So 5-year fixed rates now start from 5.64%. Virgin have also made some rate reductions, pricing there from 5.32. Conversely, the Leads have increased their 75% loan-to-value rates but up to 0.4%. So they're currently now from 5.89%. Paragon made some reductions to their 70% loan-to-value 2-year fixed rates. So now from 4.85%, but you do need to watch the arrangement fees with these guys. They also released a new 5-year limited edition rates. Now these rates are higher, but they have flat arrangement fees. So whether the trend is very much drive down the interest rate by offering these really large arrangement fees. Paragon have, I don't know, I guess they've listened to feedback, taken on board the fact that not everyone actually is comfortable with these fees. So they've brought out a product where the interest rate is a bit higher, pricing here from 6.54, but with a flat arrangement fee, 995. Paragon, as you guys I'm sure will know by now, really fantastic lender, limited companies, no maximum number of properties in the background, HMOs of up to 20 rooms, multi-unit blocks up to 20. So actually, for these larger HMOs and larger blocks of flats, paying these big arrangement fees isn't for everybody. So actually having a flat arrangement fee can be really, really good. Now, we've also seen Capital Home Loans, we've not heard from them for a while, reduce their 5-year fixed rates. These are now starting from 5.94. Aldermore have introduced some limited edition products. These are now from 5.89%. Now, Aldermore are able to lend on one property, so one mortgage on one property, or they also have what's called a portfolio loan, so one mortgage secured against multiple properties. Now, there's lots of pros and cons actually for these multi-property facilities. The pros are that it's one mortgage application, one set of administration, one set of legal costs. In terms of managing the sort of mortgage going forwards, it becomes quite straightforward. The complexity arises when you want to sell one of your properties. So if, for example, you had one property worth £100,000 and your original mortgage was at 50% loan to value, let's say, so 50,000, you'd be forgiven for thinking that when you sold the property, you'd only have to pay back 50%. So to keep the overall loan to value across the portfolio at 50% where it was. But actually, the lenders all lenders who have this kind of arrangement have the right to ask for the full proceeds of the sale should they wish. Now, it's not a given they will ask for that, but they can ask for it. So just be very, very mindful of that. Now, we've seen Keystone reduce some of their rates. Pricing is now from 4.94. Obviously, on those kinds of rates, watch the arrangement fees there. And we've seen Fleet come back with 2-year fixed rates. They haven't had any 2-year fixed rates for a while. I think it's been very hard for lenders, and it is still very hard actually for lenders to price 2-year deals because of swap rates being more volatile in the 2-year level than the 5-year. But they brought them back in. They're available for their standard properties and limited companies, HMOs and multi-units. So with Fleet, HMOs of up to 6 rooms and multi-units of up to 10 self-contained units. We've seen Quantum Home Loans reduce their rates by up to 1.1%, and their pricing is now from 6.39, which I appreciate will sound very, very high. Quantum are a lender who really do service the very sort of niche end of the market. So they can do things like very short leases on properties, lending where there are vulnerable tenants. So you might have an arrangement with a company who then lets the properties out to vulnerable people. They can take these on. So actually, despite the fact the pricing is higher, they have some really amazing kind of strings to their bow. And lastly, we've seen Market Harborough, who we don't talk about very often. They're an incredible lender. They've reduced their rates by up to 0.7%. So pricing here is now from 5.34%. Now, Market Harborough are very, very niche. So as an example, they don't really have a rental calculation. Everything is done on overall affordability. So they bring into account your own income as well. They can lend on properties which you let to family members, they lend to expats, and there's no credit scoring with these guys. So what they'll do is pull your credit report, look at it, and make sure that actually, as long as there's no really kind of significant nasties on there, they would be able to lend. So they're not relying on a credit scoring system, which can sometimes let people down. So in the main, a really positive week from the lenders in terms of pricing changes. It'll be interesting to see how next week shakes out. It's going to depend on how the capital markets react to the news with inflation and, rolled in with all the other stuff that's been going on. And of course, we'll just keep you posted when we see you again next time. Not much to report on lender criteria changes, bar one thing from the Mortgage Works, who have announced that when they're doing a stress test on your background portfolio, when you apply for a mortgage with them, the calculation they're using there is going to be increasing from 4.5% to 5.25%. So what they would do is say, okay, these properties in the background are all in your personal name, so they need to cover a rental calculation, which is 145%, assuming an interest rate of 5.25%, whereas previously it was 4.5%. So essentially it's become more restrictive. We've seen a few lenders doing this recently. This isn't particularly earth-shatteringly devastating or anything like that, but actually it's really kind of reflective that lenders are actually becoming, now they've kind of dealt with the front end of the applications in terms of just pricing the rates and things they need to do, sort of apply, as it were, to the property that's coming to them. With the amended stress test, what they're now doing is saying, actually, if someone's got a back book of properties, we also now need to kind of just reconsider whether the mortgages across those are going to be affordable in the long term. Okay, now the property investment platform Source Franchise has analysed UK house prices and rental values and yields in June 22 and then June 2023 to see how a difficult economic environment has impacted buy-to-let returns. Now, first of all, the data showed that the current average rental yield in the UK is 5.2%, which is 0.4% higher than this time last year. Now, the strongest yields, which they say indicate the best places to invest right now, I'm not sure I necessarily agree with that statement, but anyway, are currently available in Scotland at 5.9%, Northern Ireland 5.7%, the North West at 5.5%, Yorkshire and the Humber at 4.9%, and London at 4.7%. You don't often see London on these hot lists of yields, do you? They also said that Scotland leads the way in terms of annual yield increases, rising by 0.64%. With 0.49% growth, London is also performing well, as are Wales at 0.35%, the West Midlands at 0.34%, the North West 0.34% also, and also Yorkshire and the Humber at 0.34%. The South East, which is obviously where I have my buy-to-lets, which is perfect, is the only region to have recorded negative numbers, with the current yield of 4% marking an annual drop of 0.02%. So there you go. If you're thinking about investing, not sure where to do it, that might be a little bit helpful for you. Now, this may also be helpful if you're thinking about investing in the next year or so. So the JLL Tenant Survey report for 2023 has been released, and it makes really interesting reading. So first of all, 1,400 tenants were surveyed, so a really large chunk of tenants. And so it was really interesting to kind of read what tenants are looking for when they're looking for a property to rent. So first thing to note, of the 1,400 people that were surveyed, 47% of those live in London and 89% were under the age of 45 years of age. There's the kind of demographics. 47% had been in their current home for less than a year and 29% for less than 2 years. Only 12% of people who were surveyed had been in a house for more, or their home, sorry, for more than 3 years, which shows there's quite a lot of churn, doesn't it? 80% of the people surveyed expect to move in the next 2 years. Now, why is that? So 29% are planning to buy, 22% want to move to a larger property, 17% want to move to a more affordable location, 11% want to move to a smaller, more affordable property but in the same area, and 6% want a more energy efficient property, and the rest would fall under the kind of category of other. Now, one thing that they mentioned, which I find quite interesting, and it's just worth kind of being mindful of in terms of the stress on people's incomes at the moment. So 22% of people that responded spend more than 50% of their net take-home pay on rent, and that's an increase of 16% compared to last year. 38% spend between 5 and 10% of their take-home pay on gas and electricity. So you can see people's income has just been swallowed up at the moment by their rents and their bills. Now, in terms of what people are looking for in their rental properties, so energy efficiency first of all. So 76% of tenants state that energy efficiency is more important to them now than it was 1 year ago. 90% said it would be a crucial factor in influencing their decision about whether to rent a property. Why was that? So 69% want to cut their energy bills and 28% want to reduce their carbon footprint. So you can see that people are really kind of focusing a lot more on the green agenda when it comes to the property they choose to take on as their home. Now, in terms of their living priorities, so 45% of respondents never worked from home before the pandemic. However, now 72% of people split their time between home and the office, which I guess indicates that people are going to be needing at least an area within the property which they rent to be able to work from. Now, for those buildings that have communal facilities, for examples, pools, gyms, that kind of stuff, the fancy ones, 46% of tenants surveyed who had these facilities have never actually used them, which I found quite funny. Now, in terms of top priorities for renters, this is the kind of biggie. So what are people looking for? So to broadband speed, energy efficiency and a separate workspace private to themselves with their top 3 priorities. In terms of the top 3 things people would pay premium for: an on-site gym, being close to public transport, and a private outdoor space, having your own little garden or terrace. Other things that are really important to tenants when they're looking at properties, and this is the top 3: proximity to leisure facilities, proximity to green spaces and parks, and quality of pubs and restaurants nearby. Who wouldn't want a good pub around the corner, eh? So there you go. If you are thinking about buying, this may just kind of help sharpen your mind in terms of the things that are really, really important to your prospective tenants at the moment. And finally, because I know that some of you are very curious about this journey that I've been on, the latest update for getting back my buy-to-let property. So I got the property back from my non-paying tenants in June, I think it was, late June, maybe early July. The property has then been going through a kind of run of renovation work, essentially. So some of it was down to tenants not being particularly careful with the property, and some of it was just the fact that it just needed a bit of sprucing up. So the very, very good news is that my property went on the market to rent out a couple of weeks ago on the Monday, and by Tuesday I'd rented it out. So some lovely people who look like they're going to be absolutely fantastic tenants. So that's the really good news, and they move in on the 1st September. So all's well that ends well. Now, in terms of the sort of journey of getting back the rent that was owed to me, so the situation was that the tenants had no money, they'd gone into breathing space, but I did have a guarantor who had, you know, been paying their rent for a couple of months and then said, I'm not paying this any longer. So the essentially I couldn't enforce the guarantor, the kind of requirements of the guarantor to pay me any of the overdue rent because, and this is something that's probably quite a good learning point for you guys, the sort of series of how this happened was that the tenant signed the tenancy agreement and then the guarantor signed his guarantor document 2 days later. Apparently, for it to be enforceable, the guarantor has to sign before the tenant signs the AST. So actually I had no grounds or no ability to pursue the guarantor because the kind of paperwork wasn't signed in the right order. Isn't it ridiculous? So that's the kind of end of that. I've kind of squared that in my own mind. Obviously I'm incredibly annoyed, but you know, we just need to move on now. However, what also happened was that the court hearing, the Section 8 court hearing went ahead despite the fact the tenants moved out. The judge agreed that they had rent arrears and they now have both been issued a money judgment, so essentially a county court judgment saying that they owe me money. Am I going to pursue that? No, I'm not. And the reason is that to start chasing down the money is really, really expensive to do. And actually, I'm not convinced I would ever get the money from these people. It might be like £1 a month or something. And quite frankly, I'm so sick of the whole thing and life's just far too short. So I've decided to just leave things there. I've got my property back. It's going to be tenanted from the 1st September. So I think let's just look for the positives in that horrible, horrible situation. So that's how it ended. The other thing actually I just wanted to say was that I did my tax return, which is incredibly organised for me because I am normally the one on the 30th of January emailing our Human Resources Department saying, can you send me my P60 please? So the fact I did it early was unheard of. But what really got me was that so over the course of the year, because of the non-payment of rent, and then if you knocked off all my court fees, legal fees, all this kind of stuff that kind of came across, actually the kind of income, the profit from the property was like £3,000. However, my mortgage costs were like £15,000. So I still had to pay tax of over £3,000, despite the fact that my property essentially would have made a loss just because of the way the taxation works. So there you go. It just goes to show you that actually it is really quite tough in terms of taxation. And so it really is worth speaking to a tax advisor and just seeing if you can kind of look to rearrange your affairs in some way, shape or form to try and kind of help you not be in that position. And that's me for this week. So let's hope we're back with some good news in terms of interest rates next week. I think it's just going to be a case of wait and see. I think the jury's very much out in terms of how the capital markets are going to react. So for now, have a lovely week, have a lovely weekend, look after yourselves. And as always, if you have any questions, give us a call 0345 345 6788. See you next week.